Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Well, in global markets filled with rangy currencies, it's good to have rupees showing a bit more volatility. The exception to this remains equities, which have somewhat been off a rocket recently. But the themes ongoing in the market seems to be that of rate cuts, but how soon is something markets are trying to determine. Good morning, JK. Your take on market moves recently.
Good morning, Swaraj. Yes, I think on a day when US was closed, seems to have some sort of a risk of building in the market, and that probably triggered by some hawkish statements from some ECB members. For example, Mr. Nigel, who is not a hawk actually. He said that I want to see new data, and we will wait for next meeting and we will see. Like, he's not committing that ECB is ready to cut. And of course, there was a very hawkish statement from another member, Holzman. He's a known hawk, and he says that 2024 rate cut is not a given. So it was kind of pushed back against the market, which had actually started to price in the rate cut by ECB in the second quarter of this year. So that, and then we also had some underwhelming data from Eurozone. Eurozone industrial production declined by 0.3%. That's a third consecutive month of contraction. And on a yearly basis, it shrank by 6.8%. And this was actually preceded by Germany's full year GDP growth that decreased by again 0.3% in 2023 from downwardly revised 1.8% growth in 2022. So we actually have a contraction for the full year, and this is driven by stubbornly high inflation along with rising interest rates, dampening activity and demand from both home and the industrial sector. So basically, this is aligning with the gloomy forecasts that we have been seeing for the Europe's powerhouse, Germany. And it doesn't augur well for the overall Eurozone's growth. And we saw the risk of sentiment take over in the European markets yesterday, with DAX falling about 0.8%. And we also had, before the Europe Open, we had the Chinese rate decision where they disappointed the market by keeping the rate unchanged. Not that a China rate moves the market big, but then at least it would have given a boost to the Chinese economy and the Chinese stock market, which have been very poorly performing. So all said and done, we also had one more news about the US budget deficit for December rising to 129 billion versus 85 billion for December 2022. And between October and December 2023, the deficit has gone up by 510 billion. So the increased deficit and the debt, which is an outcome of that, is likely to put more pressure on inflation, perhaps a growth also being challenged, and then dollar purchasing power also will be impacted. So all these put together, we had a rise in bond yields in Asian time today, particularly in the 2-year, which actually opened with a gap. 4.14 was the closing on yesterday, and today it is trading at 4.21. 10-year and 30-year also marginally up by 2 to 3 basis points. So and obviously the overnight moves in the European markets have had their impact on the Asian markets too. Australia down 1%, and Japan, after a rise of almost 5% in the last 1 week, has had a much needed corrective fall today. But overall, I think after having moved so much on the yield and so much on the equities, one can expect some sort of a pullback in both the markets. So that's what we are looking at. And of course, the ongoing conflict in the Middle East and the Ukraine, which is still lingering. All these are not to be ignored totally, and markets have been on a very exuberant mood based on the rate cut expectations, and some sort of reality check is on the cards for the markets. So that's what is reflected to some extent in the equities and bonds today morning. Of course, on India, yes, we had another test of 82.80 yesterday, having been tested once on Friday in the offshore market, but it held. We had PSU banks, coming in, strongly and buying the dollars and pushing it closer to 82.90. Today morning's Asia session has seen the rupee slightly weaken further, but not much. Around 82.93 is what we are looking at. But all said, the flows related to corporate fundraising have been helping the rupee, and yeah, if they continue to be absorbed by RBI, we may retest 83.10 on the upside, which holds the key for whether we remain in the previous month's range or whether we hold below that. So that's what it is. Meantime, we had India's merchandise trade deficit, which narrowed slightly to 19.8 billion in December from 21 billion that we had seen in the month of November. The exports, exports had a good rise on a month-on-month basis, but on year-on-year basis, there was an overall, a fall, and we also saw the decline in service exports, for the last month. And although we did have a slightly improved deficit, the net performance on the exports is slightly concerning. Perhaps it reflects the broader global economic challenges and the uncertainties that is affecting the export sector. Yes, so we are now into a full trading day, in the sense that all the markets are open, and let's see whether the risk sentiment improves going over the day. Thank you.
Thank you, JK. And just to quickly summarize, the theme is, of course, the risk of sentiment building in the market. We had ECB members who continue to be hawkish, data-dependent approach, and no commitment of a cut. Eurozone data was also not that positive. Eurozone industrial production declined by 0.3% on a MOM basis, and Germany's full year GDP growth declined by 0.3% for 2023. So higher inflation and higher cost of capital playing a part into these declines. Chinese rate decision was a surprise, with no rate cut being done against a rate cut expected by the market. And for rupee, we tested 82.80 yesterday. It held with PSU banks buying the dollars, and flows related to corporate funding has been helping the rupee being marginally stronger. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.